Welcome to Money in Motion video blog. This is Dan Perkins. Thanks for watching. Today we're going to talk about the uncomfortable time since the beginning of the month of May. In some of my letters to clients, I said recently that I felt that the market had come too far too fast and that I was looking for a correction. There's an old axiom in our business that's called sell in May and go away. Well, it appears that we hit our market high just around May 1st, last day of April, and since then we've declined about 6.5%. Very unnerving, not unusual given the movement that we've had in the market since last October, but there's a lot of fundamentals that are changing that should give us some concern. The Greek crisis that we went through last summer seems to have come back to haunt us again. The voters have rejected the austerity moves and selected a more leftist government. And that new elected official was unable to form a government, so there's going to be general elections in June. And the consensus at the moment is that the Greek people will reject all of the austerity moves, in fact, want even more concessions from the government. More pay, if you would. The euro is under some pressure. The idea that the whole European thing could unwind. There's discussions about Greece pulling out of or being forced out of the euro, and can be Italy and Spain be far behind, as in addition to putting pressure on the euro, has caused a concern about the prospects for global growth. And so many economists are beginning to cut back on their growth forecasts for GDP on a global basis for the rest of this year and going into 2013. That includes the United States. Some people feel that this whole decline in the stock market was not a result of Greece, but more of a factor of the jobs number reported 2 weeks ago, where we only had about 120,000 new jobs. I think what's important is that there are only so many job numbers between now and the election. And I think it's about 4, depending upon the election cycle. And so if the president is going to be the first president elected with an unemployment rate above 8%, the likelihood of that happening will continue if we continue to see sluggish growth in jobs. I really believe that a number that's flat in one of the ensuing months to come, meaning minimal job growth, could probably sound the death knell for the Obama administration. I find it hard to believe that people will go into the voting booth and vote for an incumbent president who's added $4 trillion and doubled the unemployment rate and created virtually no new jobs. I'm not saying it can't happen, but I think that every day that goes by that the economy does not strengthen, that there's not a significant increase in growth and jobs. We must keep in mind that we get elated at about 120,000 jobs, 150,000 jobs, but in reality it takes 250,000 new jobs a month to deal with the number of people coming into the employment ranks out of college ranks and immigration in high school. So at 120, 150,000 new jobs a month, we are well under what we need to have any sustained growth. Without good employment numbers, we are not going to have a good housing market. And without jobs and a housing market, we're not going to have a good economy. And a good economy is not going to be a good stock market. I said to you in my quarterly letters that I was looking for a correction, perhaps a significant one, 15 to 20%, sometime in the third quarter before the election. I don't know whether this is that correction or whether this is just a blip and we'll have a rally off of this point. We have broken some significant technical support levels, and I have this chart on the S&P 500. I want you to look at it from the standpoint of where there are bottoms and tops of this chart. About 1338 was a significant support area. We break 1338, we could trend down to 1300. We break 1300 on the S&P 500, we could find ourselves going to 1275 and could slip very quickly from 1275 to close to 12 and a quarter. At 12 and a quarter, we'd have approximately a 20% correction from the top of 1420, which would then in turn signal the beginning of a bear market. I don't see the economy growing much greater than 2%, probably less than that, in the second and third quarter before the election. So we're going to go into the election cycle with unemployment probably above 8%, housing still on the doldrums, foreclosures still rising, unemployment too high, people losing their jobs, and no real significant growth in the economy. I think it's really hard for a sitting president to overwhelm the consumer and the public that he's going to do a better job in the second 4 years than he did in the first 4 years. So I think that what we're seeing is a signal that says maybe there is going to be a change in administration. Maybe the oil price drop is not so much a factor of world demand for oil declining because the belief that we have economic growth declining, but maybe the drop in oil prices is a function that the oil markets are beginning to believe that there's going to be a change in administration. And with a change in administration, there's going to be more of an emphasis on developing American energy. If we start drilling and producing more of our own oil, bringing more oil to the marketplace and less dependent on foreign oil, maybe the oil markets are telling us that that's likely to happen. So don't know for sure. I know that our dividends are holding up very well. Our portfolios have dramatically outperformed the markets even in this downtime. And so I'll continue to watch and looking for opportunities to put money to work. And again, should you have questions, please feel free to give me a call or send me an email. This is Dan Perkins, and thanks for watching.